Are you looking at the borrower?
Totally. We start with the borrower. If you have a bad borrower, they will always be a bad borrower. So we start with the borrower, their, their reputation in the marketplace, their performance. There are good borrowers and bad borrowers. And just like Santa keeps a list of who's naughty and who's nice, my partner and I have a list.
You're
The
helping the
borrowers.
financed borrower refinance.
Correct.
To flush out old lenders so they can go and do other activities.
Correct.
And
Or it's stable. More importantly, stabilize their existing asset, finish the leasing, finish any renovations they were doing, move the NOI up, so that way they can then take us out with more traditional agency financing.
well, what's the SWOT analysis on that? Is it borrower heavy and how you would underwrite that, or is it asset heavy? What are you underwriting? Which is a very important question
Totally.
because your firm, if I may call it
Correct.
multi, is taking the thesis that irrespective of whether you invest into the borrower or irrespective of whether you invest into the asset or irrespective of whether you invest into both, the value of the property must go up. I beg to differ, and I do, Rob, because in confronting that impossible of the refinance market, which you want to delve into, that impossibility doesn't go away with your refinance. I wonder what your thoughts are about how you as a lender now, or a broker or both, are going to navigate that impossibility.
Sure. So
which is a challenge in and of itself.
Exactly. So the benefit of having been through 4 cycles is that no one can ever predict the bottom of a market.
Correct.
However, there are telltale signs of when you're potentially at the bottom.
Tell us.
And when it's time to jump in. So having been through the 90s, the dot-com bust, the GFC, and COVID, the fact is apartment values are down now 20%. Interest rates are at kind of a stable level of where they've been on average for 30 years. And we have a housing crisis and people need a place to live. And so a lot of markets are starting, apartment development is approaching a new low because people can't afford, as it was quoted in the Wall Street Journal today, between expensive construction financing, inflation and tariffs, and my construction costs. It's very hard to build a new apartment building today. So new supply is significantly down. Absorption is happening in most of these markets. And so once occupancy hits 92%, we should see in most of these markets rents to start going up. And those are we're hitting right now the bottom of multifamily. Values down 20%. This is the best time to jump into a market when you're rounding off the bottom. A new supply pipeline has been turned off. There should be rent growth coming, housing crisis, high demand for housing. So those are all telltale signs that we're at the bottom of the multifamily market. And that's when I want to come in and be lending at 65 to 80% loan to value at the bottom. So when values go up and the markets recover, that my assets should be appreciating. The worst time to lend is to come in at the top of the market. So at the start of COVID, when cap rates were 3.5% and every developer was building, that's the last time you wanted to go make a 3.5% interest rate loan. Now is a great time. Debt is more expensive and values are down. So buy low, sell high.
And I appreciate that, Rob. What I'm saying is, and it's not to drag the thesis down, it's to stress test it.
Yeah.
And the stress test is going to be not that that's only one factor, which you're buying at the bottom of the market or refinancing at the bottom of the market, is now, are you looking at the borrower?
Totally. We start with the borrower. If you have a bad borrower, they will always be a bad borrower. So we start with the borrower, their, their reputation in the marketplace, their performance. There are good borrowers and bad borrowers. And just like Santa keeps a list of who's naughty and who's nice, my partner and I have a list. So we start with the borrower. Then you're looking at the real estate asset
Correct.
and its ability to grow income and pay you back your principal. And those are the two critical aspects of being a lender.
Now, isn't the underwriting process a little bit flipped on its head because you don't know who's a bad borrower or a good borrower because the market has put a twist on the borrower itself? You're stress testing the borrower itself as well.
Well, they're
When the tide
the
lowers, you
capital
see the-
markets, having interest rates go from 3.5% to 6%, that is the capital market. But borrowers we all have long histories. Borrowers' history, we all know, and what happened in the financial market and the change in interest rate. There's still good borrowers because good borrowers will say, okay, well, we're in this situation together. We'll work with you, bank, to work out the problem. How can we work together to find this solution? This was driven by interest rates, not by our performance at the property. We're keeping the property fully leased. It's well managed. We're doing everything possible, but it's the interest rates in the marketplace, right? So I think you got to separate the current financial situation with how the borrower has performed.
I agree with that. That I agree with. So I want to make a parallel to where you first began and what you're doing now.
Yes.
So where you first began is you were analyzing and providing liquidity and taking private actors public, which in and of itself is a refinance.
Correct. It was a capital solution to a financial situation. Thank you for bringing that up. I never really thought of that. But, it was really at that start of my career that I learned to see into cycles where there is financial stress and where one has to provide a financial solution, and that the markets are always very cyclical. And more recently, that's bifurcated where now property types are cyclical, right? So a year ago, industrial was hot, office was in the shitter. Now office is coming back, industrial's at 11-year high vacancy rates. And so the markets are always cyclical, and one has to be in real estate investing, always very agile to pivot from sector to sector, market to market, because nothing stays the same.
So, Rob, you agree with me then that the parallel that I'm creating here
Yes.
is something that fits quite well in what you've done in the past.
Yes, I haven't thought of that before, but you connected the dots.
Good. So here's another observation that I have. You're a bit of on the borrower side, although you're lending or you're brokering on the lender side.
We're lending, yeah.
Yeah, and lending is a very risky business.
Well, I mean, lending is safer than being an equity investor, one.
Maybe.
And two, because we think multifamily values are at a trough, multifamily, unlike office and other retail, other sectors I've invested in, multifamily doesn't have the lumpiness that a big 10-year office lease has, right?
Tell me more about that.
And so multifamily there's always a housing shortage. So if you drop the rents, your multifamily asset, it should be always fully leased if it's a quality asset. So our view is that if a multifamily loan that we make and the developer has trouble, we'd be glad to take it back because one, we're only lending at 75% loan to value, 7 return on cost, debt yield, and that's like a 7 cap rate. And cap rates are like 5. So if our developers run into trouble, we'd be glad to take back those multifamily assets because we can lease them up and probably sell them at a much lower cap rate than the debt yield that we're taking it over. So multifamily lending is much safer than office lending. And I know, we've talked about Worldwide Plaza before, but that's an example of an office building where every 10, 15 years, the leases roll, the building becomes vacant. It takes a lot of money for TIs and leasing commissions to release the building. You can't refinance when the building's half vacant and you default on it. And that's happened decade after decade in the office sector. And particularly, I know we've discussed in the past, Worldwide Plaza. So very different property types to lend on.
So I want to talk about, now that we've really built the parallel and we discussed a lot about what you do and we've stress tested your thesis a little bit, I want to discuss what it means to be successful in traversing the impossible, specifically in the case of what you have believed to be a good opportunity to invest in. And what you've agreed to invest in, really, in my view, is the borrower's second chance. And I don't know if I want to call it the second chance because I'm having trouble. Maybe you can help me. I'm having trouble identifying or defining what success for a borrower means and what failure for a borrower means. Let's look at it from an objective point of view. Is the borrower a failure in this market today in a multifamily asset because they did something wrong? Barring fraud and malfeasance, of course. But if you're acting on as a borrower on a property today and you've done everything you could and you're still sinking into the ground, what do you have to say to those borrowers that are confronting that impossible or seemingly impossible feat? That's a really huge and psychological construct that I've been examining. My background is in cognitive psychology, by the way. I used to study rats and parrots and cocaine and heroin addictions. So to me, it's important that not only do we examine what your market fit is, but the fitness of the borrower currently, because they might be in default for other reasons other than what we were discussing, which are the external factors. So how do you define how the borrower is either escaping that impossibility or disassociating from it or dealing with it? I'd like to know from your point of view.
Yeah. So let's use 2 situations, right?
Please.
So one situation is the city of Austin. They did tremendous overbuilding and now it has an 18% vacancy rate in apartments, right? Those developers, they have their construction loans and they are having to give massive amounts of free rent out and incentives to lease up their property. So the NOI pro forma that they started with 3 years ago is probably half of what it is today. And it will take Austin quite a few years for the absorption to happen and NOI come back for the developer to be able to refinance their construction loan. Now, I can't blame the developer because the market has an 18% vacancy rate and the NOI is down. And so they have the impossible where they have to refinance their construction loan and maybe it's at now 80 or 90% loan to value. And so a solution for them will be to probably have to raise a little bit of equity to protect their remaining equity to pay down the loan and then get a bridge loan to buy them more time to do lease up and have NOI recover so they can then get a new loan for a more reasonable 65% loan to value.
That's the first situation.
First situation.
What's the second situation?
The second situation is like in the city of New York, right? They, in 2019, changed rent reform, and all these rent stabilized, rent controlled apartment owners who are buying these apartment buildings for 3 cap rates can't achieve their NOI. You had quite a few years under de Blasio of 0 rent increases. Meanwhile, your insurance is going up 10% a year, in CapEx costs. And so in New York City, those developers, just because of the law and government regulation, saw the value of their assets drop 30, 40%. And it's not like the developers did anything wrong. They were just caught between chairs with mayors.
It's funny you said that because I was literally thinking about musical chairs.
And so, in both situations, you could still be a good borrower. You're just having market shifts or government regulation shifts that have negatively impacted you. And they're facing the impossible of how do I refinance and survive another day without having giving my assets back to the lender. Now, listen, 2019 rent reform put 2 New York City banks out of business, right? So it wasn't just the borrowers. The 2 major banks in New York went belly up.